Well, it was a quieter week in the financial markets last week, something of a calm between two storms after the central bank bonanza of a fortnight ago and a busier data docket coming up this week. Nevertheless, equities continuing to gain ground, even as treasuries sold off just a little, while the dollar remains underpinned against most of its G10 peers. As I said, a pretty busy week awaits this week. All eyes on the latest inflation data coming out of the United States on Tuesday, but plenty of other event risk in the mix as well, with a busy economic docket here in the UK, the risk of a US government shutdown coming back onto the radar once more, and retail earnings out of the US in the mix as well. A busy show once again on the trade-off this week, so without further ado, let's get into things. So plenty to discuss on the show this week. Now, there may have been a cabinet reshuffle in the UK, but there's been no reshuffles here on the trade-off. Joining me, as always, my good friend Ryan Littlestone from Forex Live and Forex Analytics. Ryan, how are you doing? There's nothing like a quiet Monday morning to start the week, is there?
No, I thought I'd woken up in 2015 this morning, when 2016, when I saw the news and David Cameron walking into number 10. I thought maybe I've been in some sort of warped dream for the last 6-7 years. But yeah, it's all change on the revolving door at number 10, and lots to look forward to this week.
Absolutely. I mean, I must say, it does feel like most of the last 7 or 8 years have been a bit of a warped dream, to be honest, when you look back. And yeah, I don't think you were the only one having flashbacks to those Brexit days when you were sitting down at your desk this morning trying to work out what on earth is going on. I think one normal day in the life of British politics is too much to ask for at this point.
Yeah, I don't know if it was a dream or a nightmare. I'm still trying to wake up from it. We'll see by the end of today. Maybe Boris will be back, or one of the others will be dragged out. Rees Mogg or William Hague or someone will be dragged into one of the seats as well. We shall see. Politics, eh?
Well, exactly. Never say never. We've still got at least 6, if not 12 months until an election. So that revolving door can spin around a few more times yet. But before this show descends into a political discussion, let's get back to the markets, because as you said, there is a very, very busy week ahead. So I want to start with the US, and I want to start with the Fed in particular. There's just been a ridiculous amount of central bank speakers over the last week or so. And actually, we've got another jam-packed calendar coming out this week from the Fed, the ECB, and also from the Bank of England. A few of the MPC due to be in front of the mic as the week progresses. But what I want to focus on is what seemed like a fairly notable, and what I would imagine was a deliberate hawkish tilt in what we heard from some of the FOMC when they were in front of the mic last week. We actually spoke about this on last Monday's show, or last Tuesday for you guys watching this, that the Fed may look to retighten financial conditions. We had obviously that week where the Treasury refunding came in below expectations. We had that soft jobs number, and we also had the market interpreting the November FOMC as the Fed being done and dusted. And that really resulted in quite a substantial loosening in financial conditions. So it was interesting to see last week, not only Chair Powell coming out, but also pretty much everyone we heard from on the FOMC really towing a similar line, a more hawkish stance, certainly, really flagging again that they won't hesitate to tighten further, that they're not confident they've got to a sufficiently restrictive stance yet. They're not confident that they're at the right place just yet to hit that 2% inflation goal. And they're all flagging that uncertainty around whether policy is restrictive enough or not. And I think this is just policymakers leaving that optionality on the table to do more if they have to, and try to avoid financial conditions loosening too quickly and potentially losing the battle against inflation at this very, very late stage. But what's interesting is that the market doesn't seem to be buying it, because if you look at futures pricing or the OIS curve, hasn't really budged from where it was this time last week. We've still got just 5 basis points worth of tightening priced between now and the end of January, and we've still got about 50 bips priced by next September and about 100 bips priced by next January. So it's almost like this game of bluff and double bluff that policymakers and the markets are now engaged in. And I guess the dollar kind of finds itself in no man's land between the two, given the price action that we saw for much of last week. So I think the inflation data that we're going to get on Tuesday afternoon is really key now. Headline CPI is set to come down to 3.3 from 3.7% previously, but it's the core number that everyone's going to be watching. That's set to remain unchanged at 4.1% on the year, 0.3% on the month, which would be a little bit worrying and clearly still well above the Fed's objective. So I do think that actually if we get some slower than expected progress on disinflation, if we do get a hotter than expected inflation number, either headline or core, when that data drops on Tuesday lunchtime, perhaps that is going to be what it takes to get the market to finally listen to what the Fed are saying, in that even if another hike remains an option, they're certainly not considering rate cuts anytime soon.
Yeah, I think that's the crux of it at the moment. Powell at the moment, he's acting like the shepherd and the market's the sheep. And if a few stray too much to the dovish side, he gets his crook out and shepherds them back into the centre line.
More like herding cats than herding sheep.
Herding cats, herding chickens, whatever saying you want to use, but it's pretty much the same. So yeah, his job is just to make sure that he sticks, the market sticks to the straight path, that they're going to keep rates where they are until they get their goals met, and that's inflation back to target, maybe some softening in the jobs market. Until that happens, all he's going to do is just keep coming out. When the market gets too hawkish, he'll come out and shepherd them on that side. When it gets too dovish, he'll come out and shepherd them on that side. And this CPI data is going to be important. I mean, there's a ton of data this week that's important, but this CPI number is going to be potentially, I won't call it a make or break number, but it's either going to confirm that inflation is still going back towards target, or it's going to confirm, like we've seen in some other central banks, that maybe it is going to remain sticky, and maybe they do need to go that extra hike at the end of the year just to sort of put the lid on it finally. But the market knows that even if they do hike again, that's likely to be one more and done rather than one more and pause. So, yeah, unless the US really goes on a hot streak of the economic data, or inflation takes off markedly again, that this hike, another hike, doesn't really matter. But it's keeping those expectations away from, as you say, loosening financial conditions, getting too dovish, and undoing a lot of the work that the Fed has done.
Yeah, absolutely. And it's all about trying to make sure that the market doesn't go too far in pricing in rate cuts and get to that point where, as you say, one, financial conditions have loosened too far, but two, that it's almost got to the point where the Fed have to deliver the cuts that the market's been pricing in, and they get bullied into doing something that they perhaps don't want to be doing. So, yeah, I think we're going to see a lot more of that relatively hawkish rhetoric in the coming days and weeks, and particularly from this week's Fed speakers after the inflation data. But it's not only Fed speakers that we've got to think about, is it?
No, very much so. And so, my next topic, it sort of leads or continues what you've been saying. We've seen it from the BOC and the RBA. They've both shown how afraid central banks are of the inflation wolf. The BOC turned hawkish in their commentary leading up to their last meeting, but a softer inflation print right before that meeting stayed their hand, stopped them hiking rates. However, despite the hold, the minutes published last week told us that how close a decision that was. As it said, some officials felt that more hikes were necessary for them to reach their inflation target, and they were worried about how entrenched inflation might be, and they agreed to consider a hike at a later date. And then meanwhile, we had the RBA who went and hiked in the end, and they tipped the hike on potentially more to come, while also raising their CPI forecast quite significantly to 4% from 3.5%. And as I say, these central banks show us how scared they are that inflation does rear its ugly head again. Right now, it's not even about it going back up. They are just hiking because it's not coming down fast enough. So, imagine what might happen if it does turn higher again. And for trading it, there was not much price reaction between the BOC and the RBA meetings, but it's going to be very different if someone like the Fed or ECB feel that spooked by inflation that they have to turn higher again. And that's why we're all so data dependent at the moment. It's as important for us to trade it as obviously is important for them deciding monetary policy. So I think we need to keep an eye on the smaller central banks. There's others, Norges, and even I wouldn't say the Bank of Japan, they're off the radar. But, Riksbank, some of the smaller central banks outside the mainstream are also still got their foot on the pedal regarding potential hikes, because those stances, what affects one affects them all, and so those stances that we get from those smaller central banks are going to be still in the minds of the big boys like the ECB and the Fed.
Yeah, absolutely. It's interesting you bring up the RBA. I thought that was actually a pretty dovish hike from them last week, because obviously they delivered that 25 bips, but they also made that change to their forward guidance, basically saying, whether further tightening is appropriate rather than determining the extent of further tightening. And I think that the Aussie dollar was off about 2.5% on the week, rejecting a test of that 65 handle. And I think that just speaks to a broader point, which is that just because a central bank raises rates, it doesn't necessarily mean that currency is going to go through the roof. If it is, as we saw with the RBA last week, a kind of one and done situation where they go, here's 25 basis points, but we really don't want to do any more, and we're not sure we're going to have to do any more, so here's some pretty cautious guidance to go with that hike, then of course it's not going to be particularly bullish for the currency. The other thing that I thought was interesting, and I don't know whether you picked up on this, you mentioned the BOC minutes. It shows how fun my, was it Monday or Tuesday night was last week, that I was going through those at my desk as they were released. I thought there was an interesting line in there that was saying, and I can't remember the exact phrasing of it, but it was along the lines of several BOC policymakers were worried about the inflationary impacts of the government's fiscal policies. And I just thought that was interesting, because you don't often hear, particularly in developed markets, a central bank pretty directly going against the grain of what the government are doing from a fiscal point of view. So I thought that was interesting, and I wonder whether we might start to see similar lines from other central banks, maybe. I mean, of course, we've got an election coming up in the US next year, an election coming up here in the UK next year. You'd expect the fiscal purse strings to be loosened a bit going into those. So I wonder how much of a concern that is for central banks in a bit of a bigger picture of things.
Yeah, well, there's one bank who's been all over it, that as well, and that's been obviously the Bank of Japan, because they're waiting to see what this extra budget stimulus packages from Kishida going to do for inflation. Supposedly that's their guide for what they do with monetary policy. So yeah, the BOC mentioning that they bring these things around as and when they see fit. When they're not doing anything with monetary policy, they need to talk about something else. We've heard it from the ECB, always the last few lines of an ECB press conference, be it Lagarde, Draghi, whoever, has been, oh yes, governments need to do more on the fiscal responsibility side. So yeah, it's been off the radar for a little bit, and it might be coming back on, because if the central banks have got nothing to do, then it's down to governments to plug the gap, if you like.
Absolutely. Well, I think Eurozone governments might need to just do more in the general responsibility side. If you look at what's going on in Portugal, for example, at the moment, and now you see the ECB, the head of the Portuguese central bank might be getting implicated in that as well. So that is rapidly heading south. But anyway, we're not going to talk too much about that this week. Instead, what we do have is a busy calendar of economic data coming out here in the UK this week. A bit of a data deluge from the ONS here in the UK. Tuesday, so tomorrow, it will actually be out by the time you're watching this, I would assume. We have the latest jobs data. Now, this is just going to be an absolute shambles. The ONS are still not publishing the official labour force survey. Basically, what's happened is no one is responding to that survey. The response rate has got too low, so the data has become unreliable. Therefore, the ONS using what they're calling an experimental calculation to try and estimate where the unemployment rate is. I think that's exactly what they're doing. So they will produce an unemployment figure. It will probably be around 4.3%, but we have no idea whether that's the actual number or not. The earnings data is supposedly a little bit more accurate, and earnings set to increase by just shy of 8% on a year-on-year basis. Clearly, that's well above a pace that will be compatible with the BOE's 2% inflation target. But given the unreliability of the data, I think it's very, very unlikely that the BOE and members of the MPC are going to pay too much attention to this report. I think as a result, it's quite unlikely that Sterling will pay too much attention to the report either, given that we've really no idea of how accurate the figures are or not, whatever the case may be. I think, therefore, that the inflation data that we get on Wednesday morning is going to be significantly more important. Headline inflation set to come down to 4.7% from 6.7 prior. That's where the consensus sits at the moment. Now, a lot of this is going to be due to the base effects of last year. If you think back to October 2022, which feels like a lifetime ago at this point, I think Liz Truss was still Prime Minister then, that was when the energy price shock first came in to the inflation data, and of course that is now dropping out of the year-on-year comparisons. So we are going to see quite a significant decline in headline inflation, and of course that will mean the government can say they've hit their target of halving inflation by the end of the year. Core inflation set to remain a little bit higher, 5.8 from 6.1 prior, and services inflation, which is what the BOE are watching very, very closely, is expected pretty much unchanged at 6.7% from 6.9 prior. And I think this is going to be the one that the BOE are watching very, very closely, and markets will watch very closely as well. I think OIS prices around 40 or 50 basis points worth of cuts to bank rate over the next 12 months. Obviously, if we get a cooler than expected inflation number, we should see a bit of a dovish repricing there. And with the unreliability of the labour market data, a bit more weight on inflation than usual. And then the week wraps up with retail sales. Headline sales expected to rise by around 0.5% in October, bouncing back for a fall of almost 1% on the month in September. So clearly very, very volatile data. But again, looking there for any signs that consumers are starting to tighten their belts as the impact of higher rates continues to bite. So a busy week ahead here in the UK.
Yeah, very much so. And obviously the inflation number is going to be big. You've always got to be careful. You know, Bailey's been telling us for the last few weeks that he expects inflation to come down a chunk. We've been saying it on the show, you know, beginning of October, the energy price cap came down again. So that's going to be a big influence in the numbers. So what it does is it puts the shock on if inflation doesn't fall as much as expected. That's where the market's going to move. If we get numbers in and around what's expected, probably not too much for the pound to trade, except to maybe confirm its cut view or the fact that hikes are moving further off the table. But if it is sticky, if it's above what's expected, then I think we're going to see the pound moving high, particularly gilt yields and bonds moving high as well, as that next hike comes back closer to being a possibility or reality, if you like. Retail sales on Friday, going to be big data. It's always a funny one, always a volatile number of retail sales. I mean, obviously a lot of influence with the weather. And I don't remember a sunny day in October between you and me. Even when we met, it was pouring with rain. So, you know, that tends to put a dampener on it. But, you know, what I would say is, and I mentioned this today in our chat room, I was out Saturday in Southampton with the wife, and absolutely heaving everywhere you went. Shops busy, and not just people milling around carrying shopping bags. Maybe it's just the first week of all the Christmas stuff going up, but I stopped and looked around because it was shockingly busy. So maybe we get a bit of a wobble in October and then that picks up in November, but that's further down the line. But definitely lots of data that's going to swing the BOE trade, definitely.
Indeed, we shall see. And speaking of Christmas, the Christmas tree in Leadenhall Market down the road is already up on the 13th of November, which feels a little bit early. One last thing on the UK data, while the ONS are fiddling around with their labour force survey, can we just go back to releasing this stuff at 9:30 in the morning, 7 o'clock releases? Nobody likes them. No one's a fan. Go back to the old days. It worked fine. Go back to that. Come on, guys.
I refused to get up for 7 o'clock and be at my desk for 7 o'clock data since they changed that. I thought it was just a pandemic thing or whenever they changed it, but they haven't taken it back. So I'm steadfastly refusing. I'm going to write a strongly worded letter.
Well, Mr. Disgusted of Tunbridge Wells over here will be writing one as well. While I get to writing my strongly worded letter, why don't you have a look at the rest of the data that's coming up this week? Yeah,
because it is a very busy week, and everyone's going to be looking for the cracks in the data to get those cut trades up and running. We've already mentioned the UK CPI and US CPI and UK data this week. Some other data points I wanted to highlight that's going to give us more insight into what's going on in various sectors and economies. On Wednesday, we have some industrial production and retail sales data out of China. And next weekend, they decide whether they're going to cut or hold their loan prime rate. A lot in the press over there suggesting that they may be looking at further rate cuts over there. China had a reasonable September data-wise. Retails and industrial production beat expectations while unemployment fell. But in October, so far, things haven't looked as rosy, with the PMIs for manufacturing falling back into contraction. Services just about kept its nose above the watermark. But exports continue to slump. And inflation went negative last week too. So the data tomorrow night might determine whether China reverses some of the positivity from September. And then over in the US, we get retail sales after the CPI. That's on Wednesday. PPI, the first manufacturing numbers for November from the Empire State, and then the Philly Fed. Then we start getting some of the housing numbers via the NHAB, starts and permits on Friday. Now, each piece of good data will firm up the higher for longer message from the Fed, while any soft data is going to play into the hands of those guessing when rate cuts will come. As always, we are still very data dependent. So when trading it, roll with the beats and the misses, but always know what the market sentiment is going into each data point. If you come to a particular day and the market's bullish on the dollar and you get a soft number, you've got to ask the question, if you get a dip in that dollar, is the daily sentiment going to, reverse that move and fade that move? And then you need to look, is this data point a game changer? Does it mean the Fed are going to hike again or push them towards hike? Or does it mean they're going to be pushed more towards rate cuts? So have to go with each data point and trade in between it, but keep an eye on that longer term picture as well.
Absolutely. Yeah, there's an awful lot going on this week. I think the numbers we get out of China are going to be interesting. Obviously, we've got the activity data coming out later on this week, industrial production and retail sales. A couple of other things I'm going to be keeping quite a close eye on this week. One is and usually we would gloss over it, but the weekly jobless claims numbers out of the States. Now, neither the initial or the continuing claims print we get this week pertains to the November non-farm payroll survey. But the reason why I'm going to be watching them is the continuing claims in particular. That's now risen for 7 straight weeks in a row, which is, I would argue, a sign that the labour market is starting to lose momentum at what's looking like a pretty rapid rate. And obviously, if that extends into an 8th week, you're looking at 2 months then of pretty solidly rising continuing claims. And you then start to ask, when we get the November jobs report at the start of next month, do we then have a 4 handle on the front of the unemployment rate, which would, of course, set tongues wagging once more about the potential of a recession in the United States? And you then ask, does that dent the dollar because the exceptionalism theme is coming to an end, or does it actually cause the dollar to rally if everyone starts to look for a haven? So a fair few moving parts there. And of course, the activity data that you mentioned, we can use that in conjunction with the jobs figures to try and get a clearer idea of what's going on. But the other one I'm going to be keeping a close eye on this week is some of the corporate reports that we've got. Home Depot, or Depot as the Yanks like to call it, Target and, there's one for Blake, Target and Walmart's reporting this week, Tuesday, Wednesday and Thursday before the market open, respectively. I think that's going to be interesting. It'll be good to see how consumer spending is progressing, particularly if they have anything anecdotal to say around the inflation outlook as well. So a couple of other things in the mix there, and I think it's one of those weeks where there's almost something for everyone in the markets this week.
Yeah, very much, and you're right. Those retail earnings are going to be strong. I think they're going to be strong because we've seen good retail numbers coming out the last few months. But I think that what we've got to watch out for is the forward guidance. Are there any signs of US consumers have been spending the last couple of months, but now there's signs of things tailing off, because we are obviously going into a heavy retail period, November and December, and you've got to take both those months together these days. In the old days, it was just whatever happened in December, but now we have all these cyber sales, Black Friday, Thanksgiving, everything going on. You've really got to take 2 months together.
Yeah, absolutely. I was going to say, in the US, you've got Thanksgiving, you've got Black Friday, you've got Cyber Monday, and then you're into Christmas before you know it, and then you've got the Boxing Day sales as well. So plenty of retail bargains to be had out there for someone. Right, let's get on to some charts. So I want to start with cable this week. I think we flagged the downside risks to sterling last week, and so it's proven. Rally sellers remain in command here. We had a pretty textbook look at the 200-day moving average last week, which was 124.35, and we didn't look at it for very long because we backed away very, very rapidly indeed from that level, with the bears back in the driving seat, and we even closed below the 50-day moving average last Friday, I think it was, or maybe Thursday, and then we held below it on Friday. So I think that 50-day should be a bit of a near-term cap on any upside, with the 123 figure lurking above as a bit of further resistance. As we said, it is a big week ahead of UK economic data. Of course, the inflation figures on Wednesday morning are the highlights in my book, but I struggle to really see anything that's likely to cause the market to price in any further tightening. And actually, I think the balance of risks probably tilts towards further downside for the pound at this point. So I would favour going with that trend of rally selling all the time we remain below that 50-day moving average. I still favour selling into strength and looking towards the bottom of the recent range at 121.10, and then perhaps even down to that 120 figure before the year is out. Ryan, how are you seeing things?
Yeah, we were mentioning, when the cable was shooting up, if you're looking at it purely on the fundamentals, why would you be a buyer of the pound? And that proved to be the case last week. Quite a significant turnaround. It does keep us in this same old range that we've been in for quite a while, sort of between 121, 120, 70, 80, and up towards 124.5, which has been a big old pivot point of interest every time we've been there. So, yeah, I'm a bit neutral round about these levels. I might have a little sniff long if we get down to that 121 handle again, because it is decent support as you've marked up there. For me, I'm not, until something changes with the fundamentals, or until we see a clear trend developing, is the UK going to get bitten by all these rate hikes? I am just going to, set myself either side of the range and just try and job it in between.
Good stuff. What are we looking at here? Oh, dollar China.
Yeah, dollar China. And you mentioned it last week. I said I was going to talk about it after that hot news story that dropped about some people getting off a minibus and rushing into a building that made the press last week. No idea what that was all about, but someone made a big hoo-ha that there was a big meeting going on amongst the regulators there just because someone dashed out of a minibus somewhere. But anyway, I'm going to look at dollar China. I haven't looked at it for a long while, as I'm sure Michael's noting there. Put it on his little list about what I talk about. At the moment, we remain finely balanced. And as I spoke about China earlier, I thought I might as well give an update. Not that there's been any big moves, but sometimes that alone can tell us something. For one thing, it possibly signifies that the market does think that the worst is over for China. And so selling the yuan is perhaps limited risk reward at the moment, particularly up at these levels. However, the lack of any real exiting of these moves, of these positions, suggests the market isn't quite ready to buy the one with open arms just yet. Now, I'll remain short this one up at 736, up near that top that we've had there, the double top. It looks a good, well-defined place for shorts to lean against. I've left this pair alone over the last few weeks while we had all the data out from the US and all those moves end of month and stuff, just because it just did get a little bit volatile. But I'm thinking about stepping in and trading it more short-term, jobbing it between sort of 732, 33, 34 and down to that 727, 28 support, as we just can't seem to get through it. As I'm still really feeling selectively dollar bearish, I'll still be monitoring whether the moves in this pair are US or China related, as that will guide me in the position management and my jobbing strategy. So I'll be less inclined to pay this one on short-term intraday shorts if we're moving on poor Chinese data, and that's making this pair move higher with that one weakness. But I'll be more inclined to step in if it's purely from the US side or the dollar strength that's driving it higher. So this one, as I say, finely balanced, but maybe giving us a bit of decent room to trade it short-term whilst looking at the longer-term picture.
Yeah, indeed. I've got to be honest, I don't have a firm view on this one. The only thing I would say is I just wonder to what extent the PBOC and the other various Chinese authorities, all those bods who got off your minibus last week, to what extent they are keeping things relatively stable until we're out of the way of this Biden-Xi meeting that is, well, presuming Biden remembers to turn up, that's meant to be on Wednesday afternoon, Pacific time in the US, if I can get my time zones right. So Thursday morning in the early hours here in the UK. So I'm just wondering whether once that is out of the way, we may see a little bit more volatility here. But as you've got on your chart there, mark up the levels, and as and when the volatility comes, you can react as appropriate.
Yeah, and that meeting, it's funny. We may get something from it, and if we get relations thawing further and they're all chummy and pally, that may bring us a whole bit of risk-on move, because they've sort of been at each other's throats recently. But what we don't want to see is everything from that meeting saying, yep, everything's fine and dandy, we're all getting along, and then 5 minutes later, the US throws up restrictions on more chips or starts having up sanctions on this, that, and the others, as we've seen previously. So it's do as I do, not as I say, so to speak, for this one, I think.
Yeah, very much so. And I'm far from an expert on Sino-US relations, but given that we're 11 and a half months away from an election, I really can't see anything cooling down too much there, given that maybe the only thing that seems to unite the Democrats and the GOP at the moment is this sort of skepticism towards China. So I wouldn't anticipate the rhetoric being dialed down too much in the near term. Anyway, I want to talk about gold. We've seen the yellow metal struggle quite significantly of late. We mentioned last week, actually, that Haven demand has started to fade out of the market, and so was the case again throughout the last 4 or 5 trading days. Friday, we didn't really see much interest in the way of buying gold before the weekend to hedge any sort of headline risk. And if you look at crude, WTI is down almost $20 now from the $95 a barrel highs that we saw when conflicts between Israel and Gaza broke out at the start of October. So clearly, the perception of geopolitical risk in the market's mind is fading quite significantly. So that obviously not helping gold. And then you've got the marginally stronger dollar and that sell-off that we had at the front end of the Treasury curve last week, which both pose a headwind as well. So gold has pulled back, pretty significantly from the highs that we saw towards the middle of last month, just north of $2,000 an ounce. And we're sat on what is a pretty key level at this point. I've got my crayons out, as you can see on the chart there. So we've got the 200-day moving average, pretty much right where spot is currently trading at 1935. And just for Blake Morrow, who's now got 2 mentions in this show, I've added on some Fibonacci retracements as well, because this level is also the 38.2% retracement of the rally that we saw at the start of the conflict, when markets suddenly became attuned to geopolitical risks once more. So I think this 1930, 1935 region is absolutely pivotal. If gold is to see further upside, the bulls do need to hold on to that. A closing break below would probably open the door back towards the $1,900 an ounce handle. But I think given that we've seen the perception of geopolitical risk reduce, inflation is the main event here, because gold, in my view at the moment, is pretty much a yield play, that inverse correlation coming back in once more. But what I would say is, even though the market seems to be taking geopolitical risk in its stride at the moment, it is still there. The conflict is still going on. The potential for regional escalation is there. So if you're trading gold or if you're trading crude, particularly from the short side, I think position sizing and relatively tight stops and prudent risk management still goes a very long way here.
Yeah, I think you're right, and you're right on the geopolitical front. The market's sensing that this is now contained in its own bubble, so we're not seeing the moves in risk. You may remember this was my play of the day last week to get in short top of that 2,000 area. Didn't quite get it, and unfortunately I missed it, and we've seen a decent move down. And you're right, 1930s was an area I was looking at, that if we did see a move back down, this was going to be a potential sticky point, and thus it's proving to be. And as I look at the price right now, we're right in there. So this it can have the energy to make a significant move lower still if we get further easing of tensions over there. If Israel does what they need to do and then call a halt to it, then I can see this going back under perhaps 1900 and maybe not as far as 1800s again, but certainly we'll undo a lot of that move that we saw previously. But for the moment, the highs are the way to look at getting into shorts. I'm more of a rally seller than a dip buyer, and I think that's the way you got to play this one.
Good stuff. Well, I've just looked at your notes for your next topic, and I think you might be on the verge of saying something that gets you banned from the trade-off forever. Are you bullish on the euro?
Am I bullish on the euro? Well, yes. Euro sterling I'm looking at on this one. Third time lucky. The euro complex itself is looking fairly bullish, and euro sterling is trying to decide if it wants to push higher. The pair's spending more and more time above the 87 handle, and dips under it have been bought quite aggressively so far. What needs to be resolved is the resistance sitting around the 87.50s, which marks a bit of a sticky zone from there up to the 70s. We've had 2 attempts recently and both have been rebuffed. We do have signs that this break might sustain itself, as we've currently recently held around the 87.15.20 area, more importantly down at that 87 level as well. Support on this break higher, if it builds there, it's potentially going to give it a kicker up and will be ready to take on that higher resistance zone, and maybe push up towards the 88 handle as well. The UK data could help or hinder a move higher, but if we do see another dip and it comes again on perhaps bad data for the UK, on better data for the UK, that might be one that finds decent buyers coming in if you see this pair dipping back down again. I remain long from down near the 85s, down below. I'm still looking for further upside here. My premise is still that the UK is at risk of seeing a sharper hike-induced slowdown than others. So I'm still looking to play this from the long side for now.
God, sacrilege, being long the euro against the mighty pound.
Well, you Mr. Perma pound bear over there, you should be on the same side as well. You know, I'm killing 2 birds with 1 stone. I'm selling the euro, you like that, and I'm buying the euro, which you hate as well. You know.
Well, what that may prove is that there's just no way of ever keeping me happy, which some would say is accurate. So we will leave that to
a never-ending task keeping you happy, mate.
Exactly that. Just ask Westy. Right, let's get on to our plays of the day. Okay, I'm going to look at the S&P 500 this week. If Ryan's allowed to bring back dollar China, then I'm allowed to bring this one back as well. Keeping things relatively simple this week, the market is starting to look very, very strong indeed. I know we're a little bit softer to start this week, but nonetheless, the momentum does seem to be with the bulls. We had that break north of the 200-day moving average, a fortnight ago now. We broke and closed above the 50-day moving average last week and held onto it on a couple of tests as well, and we're now remaining above the 4,400 handle. So I think with earnings season pretty much over, obviously we've got those retail earnings to get through this week. The Fed tightening cycle all but over and data continuing to hold up relatively well. When you couple that with the pretty solid technical picture as well, I like buying into strength here. There is still some concern about narrow market leadership, the magnificent 7 of those tech stocks still propelling the market higher. But personally, I think it's tough to argue with the strong bullish momentum that we've already seen this month, and also the favourable seasonals in the mix as well. I think the S&P has declined just once out of the last 10 or 11 Novembers. So I'd be looking to buy a closing break above the 100-day moving average, which comes in at around 44.25, initially targeting 4,500 to the upside, but looking to hold that for as long as we can. Ryan, we're talking about the euro again.
Yeah. Well, this one might be favourable about, because as much as the euro is bullish, it doesn't mean we can't counter trade it. So that's what I'm looking to do with EURCAD. This is mainly a technical trade. The 148 level has been a well-used level, and we're close to trying it again. So I'm favouring a tight short close to the level. Through 148.30, the trade will look wrong, but there we may have an opportunity to flip the short into a long and try and ride the break higher if that 148 breaks. And then if it shows up as support particularly, then I'll be looking maybe to flip it long. Keep an eye on oil, obviously. If we test this level at 148 amid another lower leg in oil, I'll be less inclined to get involved, because that will mean that the CAD is moving on the back of that oil move. So, yeah, 148 in EURCAD for me. Look for shorts, and hopefully that keeps you happy as well, Michael.
Good stuff. Much better, mate. You've managed to redeem yourself right at the end there. Well done. Right, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing this together as brilliantly as he always does. Thank you for watching as well. If you've enjoyed the show, drop a like on the video, leave a comment as well. Let us know how you're trading the markets, or, you know, if you've got any ideas who might actually be running the country by this time next week when we next talk to you, and we will be back in a week's time with another episode of The Trade-Off. In the meantime, thanks again for watching, and goodbye for now.